Welcome to this week's podcast. Today, we examine the investment implications arising from the war in Iran. Steve, I'm sure you've been inundated with questions from the media 7 days a week since the assault on Tehran started, but I wanted to put some time between the start so that we could observe the results over the first 2 weeks. Markets have swung violently, and maybe that's an understatement, in response to events that, rather than heading straight down, which you wouldn't be blamed for expecting. There's much to talk about. Maybe we can start with some balance. Can you define perhaps the best case and the worst case scenarios?
Yeah, the scenarios, historically, whenever people ask, what are some of the big black swans that are out there, along with like solar flare, nuclear accident, things of that nature, closure of the Straits of Hormuz was the most likely black swan event that was in the market's psyches. It's been there since the 70s. Well, we got one. And quite frankly, the market reaction, I'm going to say, was rather tepid.
But is that maybe, Steve, is that maybe a function of the fact that it all happened in a day with the price of oil, the impact on the price of oil?
Not really. You did see the price of oil build from 70 to 80 to 90. And then we have yesterday, we're taping this Tuesday. Yesterday, we had that overnight spurt up to 115 and then back down to 85, which, as you put it to me in a Teams message, was we managed to have a bull market and a bear market in one day. The numbers that had always been thrown around were in the 150 to 200 range. And we didn't get that. In terms of market impacts, yes, there were some huge market impacts in Asia, but those were in markets that had been overheating to some extent. The Kospi, which was up, I think 20% year to date, gave back a good, maybe it was more. I don't have the number in front of me. It might have actually been more, like almost 40%. It had this huge parabolic silver-like rise. It gave back a big portion of it, as parabolic moves often do. That meandered around. You had the Nikkei moving 5-6% a day. But again, the Nikkei had been outperforming. The U.S. market yesterday at its worst was down like 2.2% year to date. That is not even, that's not even a blip.
Yeah, that's a very important point, whether you said they're year to date as opposed to just on the day. The intraday movement was minimal.
One of the things that I pointed out on Friday, I believe, if not, the days are all blurring together, was that each of the days, except for Friday, where I think people were a little nervous about going home long over the weekend, every single day, so 5 out of the 6 trading days we've had through yesterday, we had closes that were significantly higher than the intraday lows. So that is telling me that there was always an underlying bid for stocks. There was always a big undercurrent of dip buying. And more importantly, there was always a big undercurrent of FOMO. As soon as the bounce seemed to hold, as soon as there was a support level that held, the buyers came charging in, not necessarily to crazy levels, but the buyers did not want to miss that bottom. Nobody wants to miss that bottom. And I know that the F in FOMO stands for fear of missing out. FOMO is really greed. And markets continually are wrestling to find the equilibrium between fear and greed. And it told me that through this whole process, while there was more fear than we'd had for some time, greed is still probably in control, not fear.
To that point, Steve, I think a lot of people like yourselves last week said, yes, oil prices are building, but we're not near 100. And then we did that all in one day. You've really just outlined the kind of the best case scenario, perhaps. What's maybe the worst case?
The best case scenario emerged yesterday afternoon when the markets rallied because the president basically implied that the hostilities are done. Yeah. Then, of course, today we learned from Defense Secretary Hegseth that, oh, wait, we're going to be stepping up our bombing campaign today. So the two are somewhat incompatible, but it tells you that's what the markets want to hear. The markets want to hear that this will be over and done with quickly, that the oil will be transiting through the Straits of Hormuz within days, and everything goes back to normal. The flip side of that scenario is we still have I think there's been, since this whole thing started, one ship making it through the Straits of Hormuz. There's been the talk of backstopping the insurance. And by the way, without insurance, the ships aren't moving. Backstopping the insurance, it's not clear that's gone into effect yet or how that's going to work, or the idea of naval escorts through the straits. Not clear how that's going to work. Let me ask you a question here, which I don't have the answer to. Is the U.S. going to backstop the insurance for and escort tankers headed for China in this situation?
One would
How do we
think
pick
not.
and choose?
I'm not sure that Congress would like that, would they?
Yeah. And so there's a lot of unanswered questions here. And also, there's also the very strong possibility that Iran, is capable of very asymmetric types of disruption. So it doesn't take much more than a couple of drones or a small speedboat to truly to send a message that says it's not safe to go through the straits. And again, it's not collectively, if all the tankers started going, they're not going to sink them. But if those tankers can't get insurance to go through, they're not going to go through, or the insurance is going to be so extraordinarily expensive that it's going to feed into the price of crude. So the idea that this is just going to be neatly wrapped up is, I think, a bit optimistic, but that's the scenario that the market has been going on. It's basically been that this is going to that we're going to be able to tie a bow on this thing very quickly. I think from a conventional military point of view, probably that's true. I'm not going to pretend to be a military analyst. I don't know. So let me just state for the record, that's probably fair. The problem is what happens if, for better or worse, Iran has shown that they're good at drones, they're good at terrorism, and you've basically hardened the theocracy at this point. And the idea that let's say by the end of the week, we've heard the last of this, very hard to swallow.
Yeah, I would agree with that. I think that the issue is the regime change, isn't it? Which is that's what this is about from Trump's perspective, isn't it?
Is it? The problem is it's been one of several stated objectives, and I don't know. And the U.S. history, I hope that's actually not the case, because as much as I detest the regime, and I think most Americans feel that way based on their history, the other inconvenient part of history is U.S. attempts to institute regime change in that part of the world do not go well. We got rid of Saddam Hussein, and then the U.S. was mired in Iraq for years. Got rid of Gaddafi. Libya is essentially an anarchy. We got rid of the Taliban and got mired in Afghanistan for many years. I'm not saying that this is the outcome. I don't think that anybody in the U.S. has the stomach for this, but I think the idea of basically saying we're going to go in there and change the regime is very difficult. Again, because we're dealing with a theocracy, and this is not like the normal, this is not picking Democrats versus Republicans or Tories versus Labor. This is picking sides in a religious conflict. And that's not the same thing as pulling a lever for one group or another. So again, I don't want to go too far down these rabbit holes, but I think the idea is that the market has decided this is very neat. There's a neat outcome at the end of this. And I'm just saying that while there's not a catastrophic outcome at the end of this, the outcome, I think the market is a little too sanguine in thinking how neatly this can be solved. Sure, this can be solved neatly if we just said, you know what, we're done, we're out, we did what we're going to do and walk away. But even then, there's still ramifications.
Yeah, I think militaristic domination is probably the best case for the investor, and the worst case is we're just kicking can down the road for problems later, but it could be many years later. Yeah. Bring it home for us in terms of the impact on the US economy. We did see that massive jump in oil prices over the weekend and into Monday morning, hot on the heels of a terrible employment report. Could you add some color around where the rear view data intersects with the prospect of a resultant pain at the pump situation for the US consumer?
Again, best case, that number was an outlier. And we could say that even as bad as that number was, we're talking about called 200,000, a difference of 200,000 jobs in a labor force of 170 million. That is we focus on these numbers a lot, but essentially they're rounding errors. But it's the data we have, and change happens at the margin. So we do need to pay close attention to these numbers. So that's the best case scenario from this, is that, you know what, there's blips, there's numbers. We'll see how it annualizes out. This too shall pass potentially. The worst case, it's telling us there's problems in the labor market. At the same time, we got the very inconvenient problem of inflation being driven by energy prices. Now, again, I think people in many ways think it's natural to think back of, oh no, this happened in the 70s and we got this huge oil spike. As an economy, we're less dependent upon oil as an input. It's just not as important. But we're building out data centers like crazy, which do require energy. As a nation, we drive big cars, and in many cases trucks. And this will hurt. I saw a statistic today, I believe it was from Bloomberg Economics, that $80 oil essentially negates the tax refund benefits promised by the One Big Beautiful Bill. And so if you're banking on that stimulus, higher oil prices act as a tax. And the question is how high. And the other issue you have with prices at the pump is there's a ratchet effect. This has always been the case. Is if you're running a gas station, if you're running the mobile station down the street or whatever, as soon as you're going to raise your prices, as soon as you discover that it's going to cost you, if it cost you X to fill your tanks last week, and it's going to cost you X plus 10% to fill your tanks this week, you are not waiting. You're raising your price 10%. But if, on the other hand, the price comes down, you filled your tanks at X plus 10%, you're going to charge X plus 10%. And presumably that, let's say, goes back down, and you're going to move your prices down slowly because at a minimum, you have to make a profit on the oil that you have in the gasoline that you have in inventory. At a worst case, you're realizing, you know what, nobody else is racing to cut their prices. Why should I? So they move up very quickly. They come down much more slowly. That's definitely an issue as well. So you're going to have this problem. Also, and I've published this before, a chart with University of Michigan one-year inflation expectations versus the price of gasoline. And they've historically tracked very well. The only time they haven't actually was in 2000, over the basically middle of last year, where because of the tariff fears, inflationary expectations jumped dramatically while the price of gasoline stayed relatively steady. They had reconverged actually in recent months, but now you have to wonder if they persist at higher prices, does that feed into inflation expectations? So at the worst, you're talking about stagnation, turning into maybe stagflation. That's a modest case, but that can get ugly in and of itself. I think the base case here is some very modest, you'll see the term stagflation. I don't think that's really, if prices go up a little and the economy stagnates a little, is that stagflation? Yeah, I guess so, but that's not really my base case. We're not talking here about, let me also put something in perspective. Yes, we went up from 4.3% to 4.4% on the unemployment rate. And yes, that occurred as the labor force participation rate sank, which actually means the denominator in the unemployment rate was sinking at the same time. So that's not a very good sign. But historically, 4.4% is fabulous.
Yeah.
So that's why I don't want to, there's definitely currents, but let's not overstate this. I think we're still in a generally healthy economy. We're still only the market's still only pricing in a rate cut, I think as early as September, which had been about a month ago, was in June. We're still pricing in maybe 50% chance of a second rate cut, whereas we've been pricing in 2 rate cuts and a 50% chance of a third. Again, 25 basis points here and there is not, if we're not getting rate cuts because the economy is solid, that's fine. Root for that, because that's good for company earnings. That's good for all the things that make that make the economy go. If we're not getting rate cuts because the Fed is stuck in a bind amidst the slowing labor market and rising prices, that's a problem, but we're not there yet.
Dr. Sosnick, Chief Market Psychiatrist. Thank you for joining me today.
My pleasure,
always a
Andrew.
pleasure having you
Thanks.
on the show.
Thanks so much for having me. This was fun.
All right. And to the audience, please remember, if you like today's episode, please subscribe wherever you download your podcast from. Bye for now.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. Futures are not suitable for all investors. The amount you may lose may be greater than your initial investment. Before trading futures, please read the CFTC risk disclosure. A copy and additional information are available at ibkr.com. There is a substantial risk of loss in foreign exchange trading. The settlement date of foreign exchange trades can vary due to time zone differences and bank holidays. The interest rate on borrowed funds must be considered when computing the cost of trades across multiple markets,